Welcome to Chapter 16, Hedge Funds. The phrase sounds like one product category, but it actually covers a collection of private strategies that may agree on almost nothing. One fund may run equity, long, and short positions. Another may trade merger spreads, global interest rates, commodity futures, distressed debt, or tiny pricing differences, financed with a great deal of borrowed money. What connects them is the private fund structure, broad investment discretion, negotiated liquidity, performance-based compensation, and a much heavier burden on the investor to investigate the organization behind the returns. In this chapter, we will separate strategy from structure, measure gross and net exposure, decode fees and liquidity terms, and examine how prime brokers, administrators, auditors, and counterparties affect the investor experience. We will also revisit long-term capital management, Archegos, short squeezes, and the uncomfortable truth that a correct long-run thesis can still fail if financing disappears first. The final mini case presents a fund with an excellent Sharpe ratio and several reasons not to relax. Hedge funds can be sophisticated. Sophistication is useful, but it is not a force field. The objective is to understand what must go right, what can force an exit, and who controls the cash when the market stops being polite. Hedge funds sit inside a much broader private fund universe. The SEC statistics on this slide include hedge funds, private equity, real estate, securitized asset funds, liquidity funds, and other private vehicles. In the third quarter of 2025, the reported universe contained 54,392 private funds with about $26.9 trillion of gross assets and $16.9 trillion of net assets. Those are large numbers, but they are not a giant pile of cash waiting in one room. Gross assets can reflect borrowing, derivatives, short positions, and exposure that appears in more than one fund. Fund-to-fund holdings can also create double counting. Net assets are closer to investor capital, but even that total combines strategies with very different liquidity and risk. The slide also notes that the SEC's 2023 private fund advisor rules were vacated by the Fifth Circuit in 2024. That matters because a course must distinguish a rule that was proposed, a rule that was adopted, and a rule that is actually in force. Regulatory status is not decorative fine print. It changes the protections investors can expect. The practical lesson is simple. Industry scale is real, but the useful unit of analysis is still the individual fund's strategy, leverage, financing, counterparties, valuation, liquidity terms, and governance. A $27 trillion headline is impressive. It is not due diligence. This chapter develops 4 practical abilities. First, classify the major strategies and identify the return engine behind each one. A label such as equity, long, short, or relative value is only the beginning. You should be able to ask whether the return comes from security selection, market beta, carry, event risk, volatility selling, trend, leverage, or some combination. Second, measure the risk that the marketing deck may compress into a single number. That includes gross and net exposure, leverage, drawdown, factor sensitivity, liquidity mismatch, counterparty concentration, and tail loss. Third, decode the fund contract. You should understand management and incentive fees, high water marks, hurdles, crystallization, gates, lockups, side pockets, key person terms, and side letters. Fourth, conduct diligence across the full organization. That means investment process, operations, legal structure, valuation, cybersecurity, service providers, and ongoing monitoring. Notice the progression. We move from what the manager says the strategy is to what the portfolio actually owns, to how the economics are divided, and finally to whether the organization can protect and return investor capital. By the end, the question should not be, is this a hedge fund? It should be, what must go right? What can force the fund to sell? And what evidence supports the claims? Alternative is a category. It is not an analysis. 4 connected questions organize the chapter. First, what is the return engine? We will examine security selection, relative value, event risk, macro positioning, trend, carry, volatility, and factor timing. Second, how is the exposure financed? Investor equity is only one source of capital. The fund may also use borrowing, short sale proceeds, swaps, futures, options, collateral, and margin arrangements. Third, what does the fund contract permit? Fees, hurdles, high water marks, redemption notice, gates, lockups, side pockets, valuation language, key person provisions, and side letters shape the investor's actual outcome. Fourth, what is the control environment? The administrator, prime brokers, custodian, auditor, legal counsel, compliance team, cybersecurity program, and valuation process all matter. These 4 questions are linked. A return strategy determines the instruments. The instruments determine financing and liquidity needs. Financing and liquidity affect the contract. The contract and service providers determine what happens when the strategy is under pressure. A hedge fund allocation is therefore an investment in both an idea and an operating organization. The manager can be brilliant at the first and careless with the second. Markets have a long history of charging tuition for that distinction. A hedge fund usually operates through a privately offered partnership or similar legal structure. The general partner or investment manager controls the portfolio, personnel, risk process, financing relationships, valuation inputs, and service provider selection. Limited partners supply capital under eligibility, disclosure, liquidity, and governance terms written into the offering documents and side arrangements. Prime brokers provide custody-related services, clearing, securities lending, financing, margin, and consolidated reporting. An independent administrator can maintain investor records, process subscriptions and redemptions, and calculate net asset value. Auditors and legal counsel support financial statements, tax offering terms, and compliance. The markets and portfolio companies supply the securities, events, prices, collateral, and liquidity on which the strategy depends. This division of labor can create useful checks, but independence should not be assumed from a logo on an organizational chart. Investors should ask who appoints each provider, who can replace them, what information they receive, and whether your cash can move without independent authorization. An administrator can calculate a number using inputs supplied by the manager. An auditor can test financial statements after year end. Neither service removes the need to understand valuation, custody, and cash controls in real time. Renting a referee is helpful. It does not mean the game has no rules problems. A hedge fund position begins with a thesis, but the investment outcome depends on the entire path from idea to exit. Step 1 is the thesis. The manager identifies a mispricing, event, macro view, carry opportunity, or behavioral pattern. Step 2 is structure. The same view can be expressed with cash securities, shorts, options, swaps, futures, or a combination. And each instrument creates different liquidity and counterparty risks. Step 3 is size. The manager chooses gross and net exposure, concentration, a liquidity budget, and the conditions that would invalidate the thesis. Step 4 is financing. Borrow availability, haircuts, margin, collateral, term, and counterparty capacity. Determine whether the position can survive. Step 5 is monitoring. The fund tracks profit and loss, factors, basis, borrow cost, crowding, margin, liquidity, and counterparty exposure. Step 6 is exit. The fund may close, roll, hedge, reduce, gate, or side pocket positions based on price, thesis, financing, and investor flows. The critical lesson is path dependence. A position can be economically right over 12 months and financially impossible to hold for 12 weeks. Long-term capital management did not need every thesis to be wrong. It needed losses, child collateral demands, and crowded exits to arrive before convergence. The market can remain irrational longer than an investor can remain solvent. The prime broker usually expresses that point with fewer words and an earlier deadline. Hedge fund strategy labels are broad, so the real task is to identify the risk that earns the return, equity. Long-short combines long and short security selection with market, sector, style, and factor exposure that can change over time. Event-driven funds invest around mergers, restructurings, spin-offs, activism, and distressed situations. Their return depends on deal completion, timing, legal outcomes, financing, and recovery values. Relative value strategies seek small pricing gaps among related securities, which often means substantial leverage is used to turn a small spread into a meaningful return. Global macro funds trade rates, currencies, equities, commodities, and volatility based on directional or relative views. Managed futures programs use systematic or discretionary futures positions, often built around trend, carry, or macro signals. Multi-strategy platforms allocate capital across many teams while centralizing financing, risk limits, and talent decisions. None of these names is a risk report. An equity long-short fund can be a disguised growth factor bet. A relative value fund can be short liquidity. A merger fund can be selling deal break risk. A macro fund can be one crowded dollar position with several different tickers. And even a market neutral portfolio can discover that the market forgot to remain neutral. Factor decomposition, stress tests, financing analysis, and position level liquidity reveal more than the category label. 6 strategy names walk into a portfolio. The correlations usually wait until the crisis to introduce themselves. Hedge funds and registered mutual funds can own similar securities, but the investor contracts are very different. A hedge fund is typically offered privately to eligible investors through negotiated documents. The mandate may permit leverage, shorting, derivatives, concentration, and less liquid assets. Liquidity can be monthly, quarterly, annual, or subject to an initial lockup, notice period, gate, side pocket, or suspension. Fees commonly combine a management charge with an incentive allocation. Reporting is negotiated, and public portfolio disclosure is limited. A registered mutual fund is publicly offered under a standardized prospectus and ongoing disclosure framework. Its use of leverage, liquidity, custody, valuation, diversification, and affiliated transactions is governed by registered fund rules. Most open-end mutual funds offer daily redemption at the next net asset value, and performance fees are constrained and uncommon in retail products. This comparison does not make one structure universally better. The private structure can support strategies that would be difficult to run inside daily liquidity. It can also expose investors to more discretion, opacity, and contract complexity. The registered structure provides more standardization, but it may limit the investment opportunity set. The correct choice depends on the investor's sophistication, objective, liquidity needs, governance capacity, and ability to evaluate the manager. Flexibility is valuable. So is knowing exactly who has it. Gross and net exposure are useful, but Neither should be mistaken for a complete risk measure. Gross exposure adds the absolute value of the long and short books. Net exposure subtracts shorts from longs. In the example, the fund has $180 long and $130 short for every $100 of net asset value. Gross exposure is therefore 310%, while net exposure is 50%. That does not mean the fund has only half the risk of the market. Net exposure approximates directional sensitivity only when the long and short positions have comparable betas, factors, currencies, durations, and instruments. A high beta long book and a low beta short book can carry more market risk than the simple net number suggests. Large offsetting positions also create financing, borrow, collateral, and exit requirements. The two legs can diverge when a relationship breaks, a short squeezes, or every crowded investor tries to reduce the same trade. Derivatives add another layer because notional amount, delta, duration, convexity, and stress behavior may point to different exposures. The practical question is not merely what is net. It is what happens if the hedge stops acting like a hedge, financing becomes more expensive, and both sides must be traded at once. 50% net can still be 100% trouble if the basis decides to improvise. The phrase 2 and 20 is memorable, but it is not a complete fee analysis. The management fee is generally charged on assets or committed capital and supports the manager's organization regardless of performance. The incentive allocation gives the manager a percentage of qualifying gains that can align interests, but it also creates an option-like payoff because the manager participates in upside without bearing losses in the same way as the investor. A high water mark normally prevents a new incentive fee until prior losses are recovered, although the exact treatment depends on the documents and investor equalization method. A hurdle requires a minimum return before the incentive fee applies. Under a hard hurdle, the incentive is generally charged only above the hurdle. Under a soft hurdle, crossing the threshold can make a larger portion of the gain eligible. Crystallization determines when the fee becomes payable, which matters around subscriptions, redemptions, and volatile returns. Fee netting matters in multi-strategy platforms. One team can earn an incentive while another loses money if the structure does not fully offset gains and losses before compensation. Investors should model several return paths, not just one annual result. The same headline fee can produce different economics depending on timing, losses, recoveries, and capital flows. 2 and 20 is the slogan. The partnership agreement is the invoice. Investor liquidity is only one layer of the fund's liquidity system. A lockup prevents redemption during an initial period and gives the manager more stable capital. A notice period requires investors to request a redemption in advance. A gate limits how much can leave the fund or an individual account during a period. A side pocket separates designated illiquid assets, so their eventual value and proceeds can be allocated outside the ordinary redemption pool. A suspension can temporarily halt redemptions or net asset value under extraordinary conditions. Those terms should be compared with the time required to sell the portfolio and the speed with which financing can disappear. A fund may offer quarterly liquidity with 60 days notice while owning positions that require many months to exit without a major discount. More importantly, the prime broker or derivatives counterparty can demand additional margin tomorrow morning. That creates a mismatch between investor patience and financing patience. During stress, managers may sell the most liquid assets first, leaving remaining investors with a less liquid portfolio. They may use gates to avoid forced sales, but a gate can also delay capital when the investor needs it. None of these tools is automatically abusive or protective. The key is whether the terms are consistent with the assets, leverage, valuation process, and equal treatment. Quarterly liquidity sounds generous. Margin calls rarely consult the marketing calendar. This chart returns to the SEC's aggregate private fund statistics for the third quarter of 2025. The reported universe contained 54,392 private funds. Gross assets were approximately $26.9 trillion, while net assets were approximately $16.9 trillion. The simple arithmetic difference is about $10 trillion. That difference is useful as a signal that gross exposure exceeds net capital, but it is not a $10 trillion leverage calculation. The data combine many fund types. Gross assets can include derivatives exposure, borrowing, short positions, and assets held through layered structures. A fund investing in another private fund can cause the same underlying economic exposure to appear at more than one level. The Form PF reporting population also has thresholds and definitions that shape what is included. 3 analytical habits matter. First, state the observation. Gross assets materially exceed net assets. Second, offer plausible explanations. Leverage, derivatives, shorts, and aggregation. Third, state the limitation. The difference cannot be converted directly into one industry leverage ratio. Large data sets create the temptation to calculate first and interpret later. In private funds, that order is particularly dangerous. A clean subtraction can still produce a messy conclusion. The regulatory history on this slide follows specific failure modes. In 1998, long-term capital management showed how leveraged relative value trades could threaten counterparties and market functioning. After the financial crisis, the Dodd-Frank Act brought many private fund advisors into SEC registration and created a stronger systemic risk reporting framework. Form PF began collecting confidential information about exposures, leverage, liquidity, counterparties, and strategy. In 2021, Archegos showed that concentrated total return swaps and fragmented dealer information could create enormous hidden exposure outside a traditional hedge fund. Each counterparty saw part of the picture. The market eventually saw all of it at once. In 2023, the SEC adopted new private fund advisor rules covering statements, audits, certain activities, and preferential treatment. In June 2024, the Fifth Circuit vacated those rules, and the newly adopted provisions are not in effect. The lesson is not that private funds are unregulated. Advisors remain subject to anti-fraud, registration, custody, marketing, compliance, market, and reporting obligations depending on their status and activities. The lesson is that regulatory status must be checked, not remembered from an old slide. A proposal is not a rule. An adopted rule is not necessarily a surviving rule. Finance keeps receipts. Courts occasionally return them. Long-term capital management remains one of the most useful hedge fund cases because the strategy was not simply reckless directional speculation. The fund employed highly regarded traders and academics, sophisticated models, and relative value positions based on relationships that appeared economically reasonable. The problem was the combination of small expected spreads and very large financed positions. In 1998, Russia's default and a global flight to liquidity caused many supposedly separate trades to move together. Investors wanted the same safe assets. Crowded relative value positions widened rather than converged. Losses produced collateral demands, and the need to reduce positions threatened to push prices further against the fund. Leverage magnified small changes. Correlations rose because liquidity became the common factor. Crowding made exits expensive. Counterparty fragmentation meant each dealer could see its own exposure without seeing the full system-wide concentration. The fund's long-run thesis did not receive unlimited time to work. Financing imposed a deadline. That is the enduring lesson. Model risk includes the possibility that historical relationships fail precisely when the portfolio needs them most. Stress tests should include widening correlations, disappearing market depth, larger haircuts, and simultaneous counterparty action. Diversification by ticker is not diversification if every position is short the same panic. The LTCM models were sophisticated. The margin calls were wonderfully simple, more collateral now. This matrix separates two dimensions: asset liquidity and leverage or model complexity. It is a framework, not a permanent ranking. Equity long-short strategies often use liquid listed stocks, but short borrow, factor crowding, and concentrated positions can still make exits difficult. Global macro and managed futures can trade highly liquid futures and currencies while using complex leverage and fast-moving margin. Merger arbitrage usually holds publicly traded securities, but the return depends on deal timing, break risk, and the ability to manage crowded exits. Fixed income relative value often combines small pricing gaps with financing derivatives and securities that do not trade continuously. Distressed credit may use less mark-to-market leverage, yet the underlying assets can require long lockups, legal workouts, and uncertain exit dates. The positions can move. A large disciplined macro fund may have excellent liquidity controls. A small equity fund can own securities that are liquid only until everyone sells them together. Investors should ask how many days it would take to exit under normal volume, how that estimate changes under stress, and what collateral must be posted before the exit is complete. The correct match is between investor liquidity, asset liquidity, and financing liquidity. A fund can be liquid in the brochure, illiquid in the portfolio, and urgently liquid at the prime broker. That is not a triangle investors want to discover during quarter-end redemption season. A complete hedge fund diligence file integrates investment and operational analysis. Step 1 is Edge. Identify the source of return, evidence that it exists, competitive pressure, capacity, decay, and the conditions under which it fails. Step 2 is Risk. Review gross and net exposure, factors, leverage, concentration, liquidity, margin, counterparties, scenario loss, and tail behavior. Step 3 is terms, model management and incentive fees, hurdles, high water marks, lockups, gates, side pockets, key person provisions, side letters, and suspension rights. Step 4 is valuation. Understand price sources, models, overrides, hard to value assets, independent testing, the administrator's role, and conflicts. Step 5 is operations. Evaluate people, segregation of duties, cash controls, prime brokers, administrator, auditor, legal counsel, compliance, cybersecurity, and business continuity. Step 6 is monitoring. Define the data, attribution, exposure reports, service provider changes, incidents, drift, and redemption triggers that will be reviewed after investment. The process should include independent evidence. A famous manager, smooth return series, or respected prime broker is not a substitute for confirming where assets are held and who can move cash. Some of the industry's worst failures were not caused by a bad market forecast. They were caused by weak controls and investors accepting elegance where evidence was required. Alpha is optional. Getting the capital back should not be. Now apply the framework to the relative value fund on the slide. The historical record looks excellent. A 1.8 Sharpe ratio, 6% annualized volatility, and only one losing quarter in 5 years. But the fund uses swaps and finance bond positions, offers quarterly liquidity with 60 days notice, reports only monthly gross and net exposure, and relies on manager-provided valuation inputs for 35% of assets. The latest month adds 3 warning signals: a 2% loss, a 20% increase in margin requirements, and prime broker concentration rising to 55%. Do not reject the fund merely because it is complex. Do not approve it because the Sharpe ratio is attractive. First, request factor and scenario analysis. Smooth returns may reflect skill, stable carry, stale marks, short volatility exposure, or several of those at once. Second, compare asset liquidation time with the redemption terms and the speed of margin calls. Third, examine the valuation hierarchy, independent price verification, model overrides, and whether the administrator challenges manager inputs. Fourth, stress the prime broker concentration. What happens if that broker changes haircuts, reduces financing, or disputes collateral? I would not make a new allocation based on the evidence provided. The appropriate recommendation is conditional diligence with explicit data requirements and a stop if transparency, valuation independence, or financing contingency planning remains inadequate. A high Sharpe ratio is evidence. It is not an alibi. Pause here and prepare one recommendation, one risk calculation, and one additional fact you would demand. Pause the presentation and answer these 4 questions before checking the speaker notes. Question 1. What does a high water mark generally do? Does it guarantee liquidity, limit new incentive fees until prior losses are recovered, set gross exposure, or eliminate management fees? Question 2. Why can low net exposure be misleading? Is net always wrong? Can large offsetting positions still create leverage, basis, liquidity, and financing risk? Does net ignore only all fees, or does low net mean the fund owns cash? Question 3. What is a side pocket? Is it a sales load, a separate account for designated illiquid assets, a benchmark, or a prime broker fee? Question 4. What happened to the SEC's 2023 private fund advisor rules? Did they all become effective? Did the Fifth Circuit vacate them in 2024? Did Congress convert them to Form NPX, or did they become ETF rules? Pause now and write one sentence explaining each answer. The correct choices are: the high water mark limits new incentive fees until prior losses are recovered. Low net can conceal large gross positions and fragile hedges. A side pocket separates designated illiquid assets. And the Fifth Circuit vacated the newly adopted private fund advisor rules. The explanation matters more than the letter. A student who memorizes B has achieved a pattern. A student who understands the mechanisms has achieved something more useful. Carry 6 claims forward from this chapter. First, hedge fund is primarily a structure, not one investment strategy. The label combines private offering, broad discretion, negotiated terms, and eligible investors. Second, leverage creates path dependence. Financing, collateral, and margin can force an exit before the economic thesis has time to work. Third, net exposure is not total risk. Gross positions, betas, factors, basis, liquidity, derivatives, shorts, and counterparties all matter. Fourth, terms are part of return. Fees, high watermarks, hurdles, lockups, gates, side pockets, side letters, and crystallization determine how gains, losses, and liquidity are shared. Fifth, operations can destroy alpha. Cash controls, valuation, administrators, prime brokers, auditors, cybersecurity, and governance require independent diligence. Sixth, regulation must be current. A proposal, an adopted rule, a court decision, and a rule in force are different things. The unifying idea is that investors are underwriting an organization as well as a portfolio. The smoother the return series, the more important it becomes to understand the mechanism producing it. In the next chapter, we add another layer: currency, country, custody, taxation, and market structure in cross-border investing. A high Sharpe ratio can be impressive. It is still not a personality test, a custody report, or a redemption plan. This final slide is the refresh register for Chapter 16. The Paulsen and Hamacher textbook remains the conceptual spine. The SEC private fund statistics provide the current scale and definitions behind the industry totals. SEC materials on private fund advisors and Form PF explain the reporting and advisor framework. The announcement regarding the private fund advisor rules confirms that the newly adopted 2023 provisions were vacated in 2024 and are not in effect. The long-term capital management report provides the historical case on leverage, crowding, counterparties, and market functioning. These are primary or official sources, and they should be checked whenever the course is refreshed because reporting forms, regulatory proposals, court decisions, and market totals can change. Do not read the web addresses aloud in the video. Use them as the evidence trail behind the narration. Chapter 17 moves from private fund structure to cross-border investing. There, the security is only one part of the position. Currency, country rules, custody, taxes, settlement, sanctions, and market access can all change the return that reaches the investor. In finance, finishing one layer of complexity is often how the next layer introduces itself.